Welcome to the Radio Revenue Podcast. Okay, let's unpack this. Imagine having like a shortcut to really understanding a major global company. Not just the headlines, but the real nitty-gritty, right? Their business, their finances, even their challenges. Today, we're not just skimming. We're doing a deep dive into the annual report on Form 10K for Amcor Pill. They're a massive player in packaging. So think of this as your personalized tour. We're sifting through thousands of pages, distilling it down to the key insights for you. And we're going to look at something fascinating, how a company sees sales jump 10%, but then net profit drops 30%. It's a bit of a puzzle, and we're here to help piece it together. Yeah, that paradox is exactly why looking at these filings is so valuable. We're not just reading numbers off a page. We're looking at the strategy behind them, the operational stuff, and what they think the future holds. This is a company that, well, its products touch almost everyone's life daily. So this deep dive, it'll highlight not just what they do, but why it matters, connecting those corporate filings to, real-world impact for you.
Right. So our focus is Amcor Playlac. They're incorporated under Jersey law, funny enough, but a history going back over 150 years, roots in Australia, the U.S., and they've just done this huge merger that really changed things for them. We'll cover their main business areas, their recent financials, that sales versus profit thing, plus the impact of that big merger and the risks and opportunities they see. So what does all this detail really mean for someone who wants to be properly informed? First up, let's get a handle on who Amcor actually is. They call themselves the global leader in responsible consumer packaging and dispensing solutions. Big phrase. But their reach is genuinely huge. Nutrition, health, beauty, wellness. We're talking flexible packaging, keeping food fresh, rigid containers, drinks, things like that. Cartons for medicines, closures on bottles, stuff you use constantly. Their purpose is elevating customers, shaping lives, and protecting the future. Quite ambitious.
And that ambition connects directly to their global scale. It's vast. They organize things into two main segments, global flexible packaging solutions and global rigid packaging solutions. As of June 30, 2025, the flexible side was the bigger earner, about 72% of total net sales. That segment alone has something like 42,000 employees, 210 facilities, 36 countries. The rigid part makes up the other 28% of sales, still huge, 34,000 employees, 213 sites in 34 countries. The sheer scale is, well, it's something else.
That's an incredible footprint, seriously. 210 facilities in 36 countries for one segment, and then another 213. Wow, it's truly global.
Keeping that all running smoothly must be a massive challenge. Does the report say much about how they manage that, like specific strategies? They also mentioned expertise in different materials, polymer resin, aluminum, fiber for flexibles, and rigid containers, too. Sounds very diversified. Exactly. That material diversity is a key strength. Lets them serve all sorts of customers. Which brings up a good question. How does a giant like this stand out? The report really stresses their commitment to sustainability and innovation. They made a pledge back in 2018, all packaging designed to be recyclable, compostable, or reusable by 2025. That's ambitious. And they even increased their target for using recycled materials 30% by 2030. And it's not just talk. They back it with big R&D, spending about $180 million a year expected post-merger. Plus, they hold over 7,000 patents, designs, trademarks. That shows innovation is core to their strategy, protecting their IP.
Okay, let's shift to the money, because this is where that paradox really hits you. Fiscal year ending June 30, 2025, net sales hit $15,009 million. That's up 10% from the year before. Pretty solid. But then their net income, the profit attributable to Amcor, it dropped at 30%, down to $511 million from $730 million the previous year. That's a big swing. Why? Why the huge drop in profit when sales were climbing? Let's just stay there.
Right, and that's where you need to dig deeper than just the headline numbers. That big sales increase, mostly driven by the merger with Berry Global Group, that added 12%. But the report is very clear about what hit the profits. Several big things. First, increased costs from the merger itself, restructuring, transaction, integration costs, a total of $210 million. Think severance, closing offices, combining systems, all that. Then, higher selling, general, and admin expenses, SG&A, up $112 million, again, mostly the merger, and a $79 million increase in amortization of acquired intangible assets.
Okay, hold on. Amortization of acquired intangibles, can you quickly unpack that?
Sure. So when Amcor bought Berry, they didn't just get factories and machines, right? They also acquired things you can't touch, like patents, brand value, customer relationships. Those are intangible assets. Accounting rules require companies to spread the cost of these assets over their useful life. That expense is called amortization. It's like depreciation for physical assets, but for intangibles. Bigger merger, more intangibles, bigger expense hitting the profit line. It's a non-cash expense mostly, but it impacts reported net income. Plus, their interest expense jumped $48 million because of debt taken on for the merger.
Yeah.
So yeah, overall sales volume grew about 1%, but these huge merger costs really weighed things down. Despite some positives, like gross profit actually increasing $122 million and lower income tax.
Got it. So the merger definitely boosted sales, but came with massive short-term costs, a real double-edged sword. It shows how an acquisition can juice the top line, but really mask profitability hits short-term due to integration. You also mentioned something else, highly inflationary accounting in Argentina. What's that about?
Yes, that's a more nuanced point, but it shows how global operations work. Basically, when a country's economy has extremely high inflation, think over 100% for 3 years, standard accounting doesn't really work well. So there are special rules companies have to follow. For Amcor, the situation in Argentina led to a $16 million hit from foreign currency losses in fiscal 2025. It just highlights how specific economic conditions in one country can ripple through a global giant's financials.
Okay, let's zoom in more on that merger then. Amcor and Berry Global Group completed April 30 in 2025. This was huge, like $10.4 billion in purchase consideration. Plus, assuming $5.2 billion of Berry's debt, that's around $15.6 billion total value. Massive. They paid for it partly by issuing 846 million shares to Berry's owners and paying off $2.2 billion of Berry's debt. This wasn't just an acquisition, it was like fundamentally changing the company.
Exactly. And the strategic thinking behind it is clear in the report. They expect it to significantly boost cash generation over time, which should allow more investment in organic growth, maybe other smaller acquisitions, better shareholder returns, long-term value. The logic is bigger scale, broader product range, wider geographic reach, potential cost savings. But, and this is crucial, the report is very upfront about the risks involved in integrating these two giants. They talk about blending different company cultures, different management styles. That's always tricky. Consolidating IT systems, admin functions, coordinating across all those global sites. It's a massive task. And they explicitly state, basically, no guarantees. No assurance they'll integrate successfully on time or get all the expected benefits. That kind of honesty in a 10K is important. Signals the complexity to investors.
Right. So huge potential upside long term, but they're acknowledging serious short-term hurdles. Integrating cultures, IT. That sounds like where these big deals often stumble. Does the report give any sense of their contingency plans if things get tougher than expected? It definitely sounds like a colossal undertaking, and that profit hit really underlines the immediate cost.
And speaking of hurdles, the report has a whole section on risk factors. This is always interesting. It's like a window into what worries the leadership. Beyond the merger integration challenges, what other big risks did they flag? What should listeners know about?
Oh yeah, the risks are diverse. Reflects being a global player in a complex world. There are strategic risks, like changes in what consumers want. Maybe shifting away from certain packaging types due to environmental concerns or economic downturns hitting demand. Losing a key customer is always a risk, though they do say no single customer is more than 10% of sales, which helps spread that risk. Competition is obviously fierce. Companies like 3M, Ball Corporation, they're always innovating, so Amcor has to keep up, grow organically, invest wisely. Makes sense. They're tied so closely to consumer trends and industrial demand. What about the bigger picture? Global economy, geopolitics, how does that factor in?
That's a huge factor. The report specifically mentions recent global instability. Conflicts in Russia, Ukraine, the Middle East, tensions around China and Taiwan. These aren't just news items. They can directly disrupt supply chains for raw materials, make customers delay orders, increase costs. Also, high inflation and interest rates globally that makes borrowing more expensive, potentially cool spending. And don't forget their emerging market exposure. About 25% of sales are from places like Argentina, Brazil, China. Those markets can offer growth, but also come with more political and regulatory uncertainty. Adds another layer of risk.
So it's this whole web of global events impacting their business, not just their own operations. Any other specific operational risks that jumped out? Things related to the day-to-day.
Absolutely. Day-to-day stuff is critical too. Supply chain vulnerability is a big one. Prices for raw materials, polymer resins, aluminum inks can fluctuate wildly. Energy costs too. They say they can generally pass these costs on, but there's no guarantee they can do it fully or quickly, especially if competition is tough. Labor is another area. About 37% of their workforce is unionized under collective bargaining agreements. So contract negotiations need to go smoothly to avoid disruptions, work stoppages, and of course, cybersecurity. It's a major concern for everyone now. The report mentions risks like ransomware, sophisticated attacks. especially complex now as they integrate Berry's IT systems. They state they haven't had significant impacts yet, but acknowledge safeguards aren't foolproof. Constant vigilance needed there.
Right. So beyond the numbers and the risks, there's also the people side, the human capital, the culture. It's pretty fascinating how a company this big, 77,000 employees globally, handles that. What did the report say about their approach, especially with integrating all the Berry employees?
Yeah, and that's arguably just as important as the financials for long-term success, especially post-merger. What's really noticeable is their deliberate effort to build a unified culture. They launched a new culture framework. It's built around a shared purpose. Together, we elevate customers, shape lives, and protect the future. And that's backed by 5 core values: safety, customers, winning, agility, and sustainability. Plus, specific behaviors they expect. Now, this isn't just HR fluff. It's a strategic necessity. Trying to blend Amcor's 42,000 people with Berry's 34,000, each with their own history and ways of working, that's tough. This framework shows they understand that synergy isn't just on paper. It's about people working together effectively. They also talk about leadership development, succession planning crucial for a 150-year-old company, and their safety record is worth mentioning. A total recordable incident rate of 0.27 for legacy Amcor in FY25. That's quite good for heavy industry. Shows operational discipline. How well they embed this new culture will really tell the tale of the merger's success down the road.
It really does paint a full picture. A company managing this incredibly complex integration, financials, operations, culture, all while dealing with a pretty unpredictable global stage. They're giant, well-established, but clearly still adapting, still evolving. So this deep dive into Amcor's annual report, it really drives home what it means to be a global leader today. You have to balance this immense scale and ambition with just constant detailed attention, financial performance, operational efficiency, all those external risks. And that paradox we started with, sales up, profit down, it just highlights the huge upfront cost of a game-changing move like the Berry merger. It's a constant balancing act, growth versus stability, while also trying to innovate and be more sustainable.
Which brings up a final thought, maybe for you, the listener. How do companies of this size keep managing these huge growth and integration challenges, especially when the world economy feels so unpredictable? And what do these detailed reports, like the 10K, really tell us about their resilience, their strategy for what's next? Think about how Amcor's decisions now, the merger, the culture push, the sustainability goals, how might those play out, especially for a company whose products are, well, basically everywhere in our daily lives?
Yeah, definitely a lot to think about there. This was a deep dive into Amcor Plegat. We really hope you feel more informed about the inner workings of this major global company. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.